Hi, Hallam and Kate. So a little bit of background noise here with the cars because it's a bit later in the day, but this is going to be episode 59. Hello and welcome to A Wealthy Life. This is episode 59, and we're going to start talking about some of the jargon, some of it historical, some of it current, so that you get a better understanding of the language that is being used around these investment techniques and maybe a little bit of the history of them and why they came about. And why that's important is because overall, the best strategy in property investing strategy, financial strategy, is to invest in a cash flowing asset. So we've spoken about stocks and bonds and other things back in the past, and those aren't what I would call cash flowing. They generate dividends. So once a year you get a payout, or maybe slightly more often than once a year, but you're not looking at a regular monthly payout, something that you can rely on to a degree, as much as you can rely on any investments, but that's something that could maybe replace your wages or top up your wages or help you change your life in an ongoing way. So investing in cash flow, I believe, is crucial. Whatever else you do after you've reached your baseline of cash flow is absolutely fine. Then you can start to diversify. But if you don't have some of your money invested in, and I believe in property, invested in, for example, property that generates a regular monthly income, you don't have that security to then go and dabble with things that are either a bit more risky because they're more difficult, or more risky because maybe you don't have control over them. For example, stocks, if you just simply invest in stocks rather than trading them, you have no control over the company. So that's why I'm so pro cash flow. Now, a very specific cash flow technique is, for example, buy to let, and the slightly more advanced version of that, houses of multiple occupancy. And what that means is buying a property and then renting it either to one person or one family in the form of buy to let. So that's a traditional, I have a tenant and they're there on a contract. Or what you could do is you could buy a property and you could rent it out to a number of individuals who may or may not know one another. And that is called a house of multiple occupancy. And the difference is, in buy-to-let, you are renting the entire premise to one unit. Typically, we'll call them a family. And in the other example, you are renting a unit by its component parts. So by spaces that we will name as bedrooms. And the reason I put it that way round is because sometimes if there are two reception rooms or a living room and a dining room, some people will make one of those spaces another bedroom and denote it as a bedroom. So that is a cash flowing technique. And maybe this is a bit of a controversial thing to say, but I think that it is extremely high risk to get into property investment when you do not have the money. Either you possess the money that you're about to invest, or that you are part of a family. I'm going to use the term family rather than friends collective because friends is more complicated, but that you are part of a family collective that will invest in property. And I firmly believe in family collectives investing in property. In fact, that's pretty much what my, which book number would this be? Book 3 was all about. Property for the Next Generation was about families getting together and investing in property for the benefit of the families. Okay, so if we start with the premise that it is higher risk to invest in property if you do not have control of the cash that you are about to invest, why is that? Why couldn't you just borrow money? And one of the terms that you will hear about, although I'm not going to necessarily discuss it now, is joint ventures. And a joint venture might be where I have the knowledge, I have the time, and I come to you because you've got the money, but you don't have the knowledge and you don't have the time. And I say to you, why don't you and I go into business together? I don't use this language, but this is effectively what I mean. why don't you and I go into business together? And what we'll do is you'll give me the money and I'll go and invest it in property. And then we will share the cash flow that comes out the other end of it. So without getting into too much detail, never mind whether that's a good use of your money or anything else, how well do you know me? And why would you want to go into business with me other than I am promising effectively to sort of make you some degree of richer than you are now? You don't have the knowledge, you don't have the time. How are you going to know that I am doing the right thing with your money? You're much better off contracting with someone to do a specific job. And that's why I prefer sourcing to joint ventures, because in sourcing, we have a very clear relationship. I will do something for you, and in return, you will pay for a fee. This is the product or service that you are buying. This is the return on your money that you are going to get, and you know where you stand. And more importantly, you and I are not connected together financially as far as our credit histories are concerned, because you don't know what my credit history is, and quite frankly, I don't know what yours is. So that match, once you start taking out shared loans with one another, you are making a financial connection together. And if anything happens to the other party, that will tarnish your credit rating. And that is something that is as precious as air and blood to your life. Your credit rating is that important. So let's just go back now and look at some of the historical strategies that were around and think about why they were around and the reason that they are around. I'm almost going to give you the punchline to the story up front so that you can watch for it, is that they were around as theoretical, they called them strategies, but they were techniques, as ways of enabling people that did not have enough money to invest in property to invest in property. And that made them high risk, in my opinion. And I will show you how, in like 2 or 3 examples I'm going to give you, they were high risk in different ways. So when I first got into property properly for myself, I'd already invested in 2004, but I would say I didn't know what I was doing. I invested along with my sister. We used the help of a sourcing agent. He was a great guy. He did what he said. He followed his contract, and we paid him for that service. And that enabled us to get on the property ladder back in 2004. And that then enabled me, as the property values climbed in 2007, to remortgage those properties and enable me to then start investing in 2008 using my own time, knowledge and skill, which I'd then brought up to a level where I felt that I could go out and do this on my own without the help of somebody else. Not without the help, I still had mentors, but I was doing it rather than a sourcing agent was doing it. So the market was starting to gear up towards the end of 2007 and 8, a bit ironically, really, because it was both gearing up and becoming a little bit sensitive, because we were in a position where we had problems in America with loans and the start of what would actually be the recession, depression that came about in 2008. But the property market was still very busy. And in part, this was because of a lot more property training companies out there, property networking events, and the availability of buy-to-let mortgages. So something had shifted in the market that made it favorable to, or an easier entry point to investing in property. And then there was all the marketing that went on alongside that meant that you could access the money and everything else that was going on. So if there's a buzz about something, like there was a buzz about crypto when that came around, and at the moment there's a buzz about AI, what happens is that there will always be early adopters, as there are in any sort of business environment. And those early adopters will get themselves into a position where they feel like they know what they're doing. They then have maybe some case studies and some marketing, and then they can go out into the market and then promote not only what they've done, but also sell that and package that in ways to other people. And I don't see that that's such a bad thing. If you had run a marathon and run a marathon in a good time, then there's nothing wrong with you then using that experience and skill to teach other people how to run marathons. But what was happening is he had very creative souls that recognized that there was this tier of people that were interested in investing in property, but didn't have all of the cash required. So they had some cash, but not all of the cash required to make that entry actually into the point of buying a property. And so what they did was they started to look at strategies that would allow you to manipulate the circumstances of buying. So a normal way to buy a property, whether you're residential or an investor, is that you would either buy it outright for cash, and that's absolutely fine. When you do the maths, it doesn't make sense to buy it outright for cash when you are going to invest for the longer term, because using all your money on one house. So for example, £100,000 buys you one house, but actually you could use that £100,000, split it up into 4 and use it as a 25% deposit on 4 other houses that also cost 100,000. That's just to keep it simple. So that's the normal way of doing it, with a deposit. And yes, you'd need a mortgage and you'd need your surveys and all of that sort of stuff. We're going to just skip over that bit for now. So what if you didn't have enough money? For example, you didn't have £25,000 to put down as a deposit, plus the other costs you might need to buy your first house. Would you be interested in a no money down deal? So M for mother D, no money down deal. Back in sort of 2008 and onwards, no money down deals were a way that clever people with the maths and jiggering around with the finances could help you, and there would be a fee for this, to buy a property without having to put down a deposit. Your only cost of buying that property would still be the solicitor, the survey, etc., but would be a fee to them to facilitate this process. And the fee to them to facilitate this process would obviously be less than the 25% deposit that you required to buy the property in the first place. And I'm not going to get into the different ways, because there were a number of flavors of no money down deals. It was about you, in a sense, taking out a 100% mortgage on a property. And you had to take out a 100% mortgage on the property because the seller still wanted, for example, we'll keep to the same numbers, £100,000 for their property. And you're coming along and saying, I want to buy it. And if you had the money, you would have put down a 25% cash deposit, £25,000, and borrowed £75,000 via a mortgage from a lender. And because you don't have the £25,000, and we're going to do some clever jiggery pokery, you still have to somehow acquire £100,000 in this simple version of it to give to the seller without doing the deposit that you would have required. And therefore, you're going to end up at the end of this process with a number of solicitors and brokers and processes involved, taking out a mortgage for 100% of the property. And why is that risky? Because actually what happened, and we didn't know this exactly in 2008, but property prices fell dramatically. And so then a lot of people ended up in negative equity. And what that means is that the loan on the property was worth more than the value of the property itself. And that position is okay. I found myself in that position on a couple of the properties that I bought early on, where I paid too much for them because I didn't sell them. I was able to rent them. I was able to afford the refurbs, and I had tenants in place that were giving me rent, and that rent was enabling me to pay the mortgage, and I could afford the interest rates, which also changed at the time. So I was able to manage that debt without having to pay any money out of my own pocket. I remember very clearly somebody who's a reasonably big name now, that when we were friends back in the early days, they had bought 12 properties and they had got no money down deals on them. And in the end, when interest rates went up, they were in a position where they were having to pay out of their own pocket £1,000 a month of property in order to pay the debt that they had, because they had large loans, interest rates went up, and they were in a very, very difficult position. Now, I don't know about you, but early on in my career, the thought of having to pay £1,000 out of my own pocket when I had been in a position where I decided I was going to work full time in property. So I had no job that I was falling back on. All of my income was coming from property. To then pay £1,000 out to feed the mortgages on the properties that I own would have given me huge sleepless nights. And so one of the issues with no money down deals was, apart from the fact that there's probably some mortgage fraud in there as well, is that you are over leveraged. And again, in 2008, you could have probably got 85% loan to values and 80% loan to values. Now you will notice that buy-to-let lenders limit you at a 75% to value, loan to value ratio. So they will only ever lend you 75% of the value of the property. And that is to provide themselves with more security, but also to check that you can afford to buy this property, that you can put, and the term is skin in the game, that you've got some of your money in this deal. And so you will pay attention and make sure that it is rented and that you will pay the mortgage, etc. So that's no money down deals. Then we move on to below market value. So this is BMV, and there was a lot of chatter about BMV. And this is basically, again, there were various versions of this, some that were, again, up the mortgage fraud end. This is where you were attempting to buy a property by negotiating with the seller at a value that was considerably less than the street value, and therefore less than the value that a surveyor would give you on the property if they didn't know how much you were paying for them. And so I got myself caught up in one of these deals. In fact, it was one of my very first deals I spoke to you about, Vale. And before we proceeded in the proper way, what we were going to do was agree a purchase price. And it just so happened, these are the numbers, that it was just over £75,000 with the seller. The value of the houses on the street could be seen by checking the data and doing your due diligence at around about the 100,000 mark. So if somebody stepped in that had the cash, they would buy from the seller on my behalf using their cash outright £75,000. They would then on that same day sell to me for £100,000. But I'm only wanting to pay 75, and I negotiated 75. That's okay, because when the deal went through, they would give me back the £25,000 extra that they sold it to me for. I'd get a mortgage covering the full amount of the genuine house price. With the money that came back to me, the cash back, if you like, I would be able to pay the fee for doing this, because effectively we'd had to go through 2 purchases, 2 sets of solicitors, 2 sets of brokers, so that each one didn't know what the other one was doing, because otherwise they'd have to inform the lender that basically we were committing mortgage fraud. Now, that sounds awful the way I've described it. That is the way it happened, but that is not what I understood was happening when I went into that program. And I only found out that that was the process, and that the process was in effect mortgage fraud, when I read the mortgage offer and I realized what it was that we were doing. Then I spoke to one of the solicitors, and he actually used the words, "You can't tell me that, I'm not supposed to know." So that's below market value. And again, the problem here was I would effectively be maxed out on the mortgage, possibly even to the point where I had paid more than really what the house was worth. Because if I could negotiate £75,000 with the seller, the chances are the house needed some work or they needed to move on in a quicker way. If the average house in the street was £100,000, probably done up nicely, my house wasn't worth 100,000. It might have been worth 90,000 because maybe some work needed doing, or maybe only 85,000. So I've already, in a sense, over mortgaged the value, and I've already bought in almost to some negative equity there. So again, very risky. If we then move forward, the next sort of set of strange techniques, if you like, that were around, and these are still around now, are lease options and rent-to-rent deals. And the reason for these is this isn't around you actually buying the property. This is about securing and controlling a property through contracts. This is completely different. You don't own an asset here. You own a contract with a permission to do something. So let's look at lease options first off. They are the bringing together of two things: a lease, which is a business term for renting a property on a long-term basis. It's a different form of contract that enables you to gain access to the property and be able to occupy that property for your own use, a lease. And then an option, which is where you then added something together in the contract and you said, I would like the option to do, and then you insert what it is that you want to do as part of your option clause. And this came over from America and Australia and was picked up quite quickly by some early adopters in the UK, who then started running courses on their own. One that's still around in the market, and one that very spectacularly collapsed because they'd over leveraged themselves. So remember that this is not about buying. So now we don't need that £25,000 to put down as a deposit at all. Now we are going to secure a property. All that we require is no broker fees to get us a mortgage. We might do a survey. Some people probably didn't. And then we're not going to have any lender fees. All we're going to have is a specific solicitor who understands how to write a lease option contract. And what you're going to do is you're going to find somebody who's in a position where they do not want to live in the property anymore. They might be a landlord getting out of the market. More often than not, if you think of the time, 2008, 2009, 2010, these were people starting to struggle financially as interest rates went up, only to the level we're at now. Base rate was up at about 4 or 5%, interest rates similar to they are today. But they had bought into their property at a lower price, and now they were feeling the pinch on mortgage payments. Maybe they'd lost their jobs. Maybe they were facing repossession. And so what they could do is sign a contract with you where you took over their house. They moved out. They had to go somewhere else, maybe to another property that they owned, or more likely they moved off into rented accommodation. And you took control of their house with this lease and option. The lease gave you the permission to rent the property out. So you now rented a property out as if you were doing a buy-to-let, but without having to put down the deposit. And the option side of it, and this is what made it feel very get rich quickie, etc., was the option was saying to the seller, I'm going to negotiate a price with you today in 2008, 2009, 2010. And with the option in this contract, I'm going to say, I want the option to buy your house at some point in the future at the price we negotiate today. But unlike with an actual exchange of contracts with a normal buying purchase, I have no obligation to complete. So if the property market had risen dramatically, say from 2008 to 2013 over a 5-year period, I would have negotiated with you the right to take your property off of you, manage it, rent it out, benefit from the rent. And then what I would do is have the option, but not the obligation, to buy the property at the price we agreed. And say, for example, we agreed £100,000, and then the property went up to 120 or 140. Obviously it didn't, but I'm doing this for effect. I would then benefit from that immediate capital gain of 20 to 40,000 pounds. And that would effectively give me the deposit, if you like, to then go around and buy the property. Or I could have saved up all of the rent from 5 years and used that as my deposit to then buy the property. And it was a way of getting into property, but making the property pay your deposit or pay you rent as you went. The next one to look at is a variation on this, and this is rent to rent, and this is still around now. And this is where you effectively become a letting agent with a strategy of houses of multiple occupancy. So you're going to go to somebody who no longer wants their property. You're going to complete a contract that says, I am going to rent your house from you, and you are going to give me permission to rent it out. And then the way I rent it out is I rent it out by the room. And the reason I rent it out by the room is renting a property with 4 bedrooms or 5 bedrooms, using up some of the living space, would give me more rental income than if I rented the property out simply as a family unit in one house. And so what that enables me to do is, again, not pay for the deposit and the broker fees and probably not a survey. And I have no option to buy this. I'm purely renting it for a period. So much like when you walk down the high street, all of those shops, those shop owners do not own those shops. They have leased those shops. They have rented those premises from a landlord, and that landlord has given them permission to run their business in that premise. What's happened is we've done that in the property world. So I'm going to go along, I'm going to rent the property off you. You're going to give me permission to run my business in your house. My house is renting property out by the room. And then what I do is I pay you a rental fee. I am paid rent by all my little tenants in the property. And the difference between the two is my profit. So effectively my wages as a form of letting agent. Now, the problems with these is they are fine. They are jobs. They are very much about being a letting agent and jobs. The lease option, probably less risk to you because all you had was an option with no obligation, but maybe a tool for unethical people to prey on the original sellers that were desperate and potentially buy properties that are undervalued and steal the capital gain that did originally belong to the original homeowner. Rent to rent, there's a lot of conversations about this in terms of whether people have permission, whether the existing landlord knows what's going on. There have been some big court cases about rent to rent, one more recently. I'm not going to go into all of that because that's not the point. So these are about contracts and about control. They're not about purchase. They are about getting a wage rather than cash flow, because cash flow is where you're leveraging your money with minimal management, because you're going to use a letting agent as well, minimal management, minimal amount of your time, and you're like the managing director of the business, and your letting agent is the manager of the business, and your tenants are the customers in the business. In lease options and rent to rent, you didn't usually put a letting agent in the way. You did this, so it was a job, and the money that you made on a monthly basis were your wages. Where this went wrong, and I remember it very clearly, was by about 2012, that sort of time, some less scrupulous trainers and property gurus were starting to package deals. And what they were doing was they were reselling a rent-to-rent package to somebody else who did not have the skills, had not been through even rent-to-rent training as a way of learning how to do it, but saw an opportunity to, in a sense, get rich quick. So what I would do is I would find a property that someone would sign a rent-to-rent contract on. I would work out that by renting this property out on a room-by-room basis, that you could, let's say you could make £500 a month clear profit after you've paid the actual owner back. So what some unscrupulous people were doing was they were taking the monthly potential profit, in this case, my example, £500, timesing it up by 12, and then saying the first year's monthly cash flow, which equals £6,000 now, 500 times 12, £6,000. That is the fee for me to hand over this rent-to-rent property to you. Now, as an unscrupulous person, this is brilliant because I've got my whole system going. I've got my whole marketing team at it. I find these deals, I negotiate these deals, I find you or you find me, and I sell this to you. I'm now getting £6,000 up front for my fee for doing this. I've probably made you join some group in order to access these deals as well. And you are going to be a landlord of a property, of a house of multiple occupation with potentially 4, 5, 6 or more tenants in it. And you are going to have to manage them 24/7, 365 days of the year for no money whatsoever, hoping that none of them move out or anything else. And at the end of it, then you're going to have a deal that may actually start generating money. And people were buying these like crazy. They were actually spending money on nothing. They didn't own the house. They were going to work for free for an entire year before they made that money back. And I spoke, I think it was probably last year, to someone who has been caught up, and that's still around. There are still people out there selling these sorts of deals, and they paid somewhere in the region of £65,000 to get 5 rent-to-rent deals, which means that they are going to have to manage, when they get them, 5 properties with multiple tenants for as long as it takes for them to pay back the £65,000 worth of investment. And if you think that £65,000, if we divide that by £500 a month, if that's how much they got, and then we divide that by 12, they're going to have either 10 properties, 11 properties, or potentially 10 or 11 years before they make that £65,000 back, per property. That's not investing. That's not leveraging your money. Is that leveraging your time even? I don't know if it is leveraging your time, because you wouldn't be getting any benefit out of it. If you bought one of these deals, you're not walking away with any money at the end of it. So the lesson here is that investing is about buying a cash flowing asset where the return on the cash invested, simply put, is better than you could get in the bank, with an added factor to allow for the risk that you are taking by taking out this loan. That it is a good use of your time because you are going to use a great system, which is one of the things I always talk to my clients about. The other side of us getting a deal is making sure that that business system is in place, so that while they're doing whatever they're doing with their lives, they can use very little of their time to supervise, to higher level manage the team that is ensuring that the rent is paid, that the property conforms to legislation, and that all the repairs are dealt with. And if a key gets lost or gets broken, they don't bother you in the middle of the night. All of that is taken care of as part of the package. It is not about get rich quick. I've recently written an article, and I'll share that out in due course, about why still invest in property. Why would I say investing in property for the next 10 years, even though, particularly in the UK, as landlords, we're getting bashed a lot. Globally, interest rates are high, material costs are high, utility costs are high. Why would you still invest in property? Because at the end of it, it is, from my mind, the single asset that could both appreciate in capital value and provide you with monthly cash flow in a way that it was worth your risk to put your cash in there, based on the cash that you are going to get paid out as ultimately as profit at the other end of each month or each period that you're charging your tenants. It is not about dodgy contracts. It's about long-term investments. You're looking at 5 to 10 years for each property to make it worth having all of the effort of going through the buying process, paying the broker, paying the solicitor, paying for the survey, all of those upfront costs. They've got to pay you back. And that's why you're in this for the long term. If you just buy a house and you flip it out, it's a completely different strategy. That's called trading. And you're not getting monthly cash flow there. You're looking to buy something, add value in some way, sell it out. And that's okay when you know what the market's doing and you know that your timelines are such that you can get in and get out quickly before the market changes. But as I told you with that example back, I think it was only last week, it feels a lifetime ago. Yes, as I told you last week, the house that I first bought with the intention of flipping, because I didn't move quickly enough, market conditions, even on a very micro level, that street, the values changed, and it meant that it wasn't worth selling and I wasn't going to make the capital gain I thought I would. So I really wanted to give you some background to this because that's so important for understanding what makes a good deal, what's not a good deal, what is actually cash flowing investment, and what is a technique, and what is actually possibly a scheme or a scam, or at the very worst, mortgage fraud, a way round, a way to get rich quick. This is a serious business in which you can make serious amounts of money if you treat it like a business, if you understand what you're getting into, if you understand that you are buying a house by leveraging your cash in a way that means the rent returned is worth the money that you are risking by taking on this investment, because all investment is a risk, and that you are going to get out of it a monthly cash flow that makes you happy and comfortable with the investment choices that you're making. That's what matters. So what I'm going to do is I'm going to take this on a bit, move it forward into history, into current times. And what I'll do is I'll speak to you next week about what's best. How do you know when to buy and hold, buy and sell, remortgage, develop, all of those sorts of things, and how do those variations in a technique matter over the years of your portfolio. And overall, if you haven't read either the book Property for the Next Generation, which is the one with the green cover, and that really talks about families working together as a way of gathering your family cash together to make a difference, or you might want to look at Other People's Money. And Other People's Money, I think, is probably just a digital book. But if you wanted to contact me, I've got actual print copies and I'll happily sign you a copy. So drop me an email and I can get one of those books to you, or you can buy it through Amazon online. And I think you can get either digital or print copies of Property for the Next Generation. We'll put those two book titles in the notes for this, but it's Using Other People's Money, How to Invest in Property. It's the 4th edition, and it's out there. It's the one with my face on, or you can look at the green copybook, which is Property for the Next Generation, Securing Your Financial Future in Uncertain Times. And when I wrote this, I was talking about uncertain times a few years ago, but it's always relevant because it always seems to be financially uncertain times. As soon as we have a certain time, there's a financially uncertain time about to come. So there are 2 books there for you to pick up on this topic and read further. Using Other People's Money, How to Invest in Property will really take you through all the different investing techniques and talk to you about the pros and the cons. Property for the Next Generation is a bit more at the strategy level, saying a house isn't an asset. Your regular residential property is not an asset, and why you need to be working together as a family so that you can rethink about your attitudes towards property and what it means for your family and for your family's financial future. So I hope that I've given you some information, and I hope that as a combination of this and maybe the books, you are going to get a lot more whoosh into your life and into your property portfolio as we move forward. Thank you very much for listening, and make sure that you sign up. Please, of course, leave me a review, leave me a rating, and I will see you next week on episode 60. My name's Vicky Wishay, and this has been A Wealthy Life.